Hello everyone, today with MarketXLS we're going to talk about the protective call option strategy. MarketXLS is one of the top Excel-based investment research solution for investors. In this video we'll be discussing what a protective call strategy is, how it works, and how it is calculated using MarketXLS. So without any further ado, let's start with the topic. The hedging strategies are some of the simplest option strategies that a trader can implement. A hedge involves exposure to an underlying and then taking an option position to hedge the risk of the downside. It means if the investor has made profits from his position on an underlying stock and now wants to protect the profits from change in the trend, then he can implement a protective call or a protective put strategy based on the position he has for the underlying stock. So now let's understand the protective call strategy. This strategy is best implemented when your outlook on the stock is bearish in the near term and you're already short on the underlying. A protective call spread is an unlimited profit and a limited risk strategy. So what we do in this strategy is that we're short on the underlying and we go long on an at-the-money call option of the same underlying stock. MarketXLS offers a template for this strategy. Here's an introduction page for the users to read, and here's an active template. The yellow cells have to be inputted by the user, so the stock ticker, expiry date, at-the-money strike price for the call, and the price at which you've already gone short on the underlying stock. Some upcoming expiry dates are available for reference on the side. And for the purpose of this video, we'll be using Apple, expiry date as 18 June, ATM strike price is 125, and we've assumed that we've already gone short on the underlying at 135. So we've already made a profit of $10 on our short position for each stock. You also need to specify the quantity of stock you shorted under stock units. We've bought the at-the-money $125 call option of Apple, and we've built the net debit strategy and paid $251 to enter into the trade, which is reflected in the premium paid section. MarketXLS has many templates just like the protective call one you see here, and it refreshes all the data when you click on the Refresh All button. A payoff schedule and a payoff diagram are available in the template too. They can be used to analyze the maximum gain, loss, and break-even. Without the hedge, using a call strategy, the stock was prone to unlimited loss if the stock price increased. By going long on the call option, we'll profit from the stock price appreciation and thus hedge the downside risk. As you can see, the profit that we made from shorting the stock at $135 is protected. As the stock price increases, the fall in profit from underlying is compensated by the gain in call option position. And thus, the minimum profit you can take home is $749. It is important to note that in finance, there's no free lunch, and this hedge too comes with a cost. The downside is that if the stock price continues to fall, your net profit will be lower by the amount of premium paid as the option will expire out of the money. That is all for today. If you want to read more about this topic, please visit the MarketXLS website, which has hundreds of blogs and templates. If you want to get in contact with us, please book a demo and we'll be happy to help.